Welcome to the Deep Dive. Today, we're really digging into a critical decision for any business thinking about going global.
Uh-huh. Where to actually set up, especially if you're considering a holding company structure.
Yeah, exactly. We've lined up three big players: the Netherlands, Luxembourg, and Singapore. We're going to sort of break down what makes each one strategic.
Yeah, the goal really is to give you, the listener, a clearer picture of the core differences.
And maybe highlight some of the real-world advantages as you think about expanding internationally.
Right, because navigating this international stuff, it can feel, well, pretty complex.
It definitely can.
So hopefully this deep dive simplifies things a bit, focusing on what really sets these three popular spots apart for holding companies.
Okay, let's jump in then. When we talk about setting up, what are the sort of standard company types we're looking at here?
Well, in the Netherlands, you're generally looking at the BV.
Okay.
In Luxembourg, it's the SARL.
KRL, got it.
And Singapore uses the private limited company, usually just PETA Ltd.
PETA Ltd, right. So different names, but fundamentally limited liability companies.
Exactly. But where things get immediately interesting is the initial money you need to put in, the minimum share capital.
Ah, okay. Tell us about that.
Well, this is pretty fascinating. The Netherlands basically says, 0.01 is technically enough. There's really no practical requirement beyond that.
Wow. Okay. Almost nothing.
Almost nothing. And Singapore is also super accessible, just one Singapore dollar.
Which is what, like less than €1?
Yeah, around 65 euro cents or so. Very, very low.
And Luxembourg.
And then you have Luxembourg, which requires a much more significant 12,000.
12,000. Okay, that's a big difference.
It really is. It signals a different kind of initial commitment, doesn't it?
Absolutely. So for maybe a lean startup, that tiny capital requirement in the Netherlands or Singapore could be, a pretty big plus early on.
Definitely a factor. Makes entry feel a lot easier.
Right. So, okay, the company's set up, it's making money. Now you want to send some profits back to the shareholders. Dividends. What about the tax hit there?
Yeah, the dividend withholding tax. This is another area where the picture looks quite different depending on where you are.
Okay.
So both the Netherlands and Luxembourg, they have a standard rate of 15%.
15%.
But, and this is really important, both have huge networks of double tax treaties.
Ah, the DTTs.
Exactly. And these treaties can often bring that 15% down, sometimes even to zero, depending on where the shareholder receiving the dividend is based.
Okay, so that 15% isn't always the final number.
Not necessarily no, but then you look at Singapore,
And
0%, just flat out 0% dividend withholding tax.
wow, okay, that sounds very attractive.
It is. If your main goal is getting profits back to investors or a parent company without an immediate tax bite at that stage, Singapore definitely has an edge there.
Right, that seems like a clear win for Singapore on that front. But, that's just the tax on the way out. What about the tax on the profits inside the company? The corporate tax rate.
Exactly. You've got to look at the whole picture. Corporate tax rates add another important layer.
So how do they stack up?
The Netherlands uses a tiered system. It's 19% on profits up to 200,000.
19%.
And then it jumps to 25.8% for profits above that level.
Okay, a two-step system.
Right. Luxembourg is similar, also two tiers. It starts at 17% for profits up to 200,000.
It's 17, slightly lower than the Dutch first tier.
And then it goes up to 24.94% above that. So roughly comparable top rates to the Netherlands.
Okay, and Singapore, I remember you said 0% on dividends.
For corporate tax, Singapore keeps it simpler. It's just a flat rate of 17%.
17% flat. Interesting. So lower than the top rates in NL and Lux, but maybe higher than their initial rates?
Precisely. For a fast-growing company that's maybe reinvesting most of its profits early on, that lower first tier in the Netherlands or Luxembourg might actually mean less tax paid initially compared to Singapore's flat 17%.
That's a really good point. Depends on your profit levels and how much you're taking out versus putting back in.
Exactly. It's about your business life cycle and your margins.
Okay, that makes sense.
Yeah.
Now, what about, say, selling off assets? Like if the holding company sells shares in one of its subsidiaries, capital gains tax.
Ah, yes. Capital gains. That's critical, especially if you're thinking about investments or maybe an exit strategy down the line.
So how do they treat it?
Well, the Netherlands, it doesn't actually have a separate capital gains tax for companies.
Oh,
Any profit from selling assets just gets treated as normal business income and is taxed at the regular corporate income tax rate.
I see. So it's folded into the main CIT.
Exactly. Luxembourg is interesting. For individuals, there's generally no capital gains tax on securities. For companies, it can be exempt under the participation exemption, similar to dividends.
Okay. And Singapore again?
Singapore, again, stands out with a very straightforward approach.
Let me guess.
0.
You got it. No capital gains tax at all.
Okay. That seems like a pretty significant advantage, especially for investment holding, or if you plan to sell the business eventually.
It absolutely can be. It simplifies things massively and reduces that potential tax hit when you sell assets or shares. A big plus for Singapore there.
Right. So we're definitely seeing patterns here, different strengths depending on what the business is actually doing.
Totally.
You mentioned double tax treaties earlier, the DTTs. You said they were crucial. Can you expand on that a bit? Why are they so important?
Yeah, DTTs are basically the bedrock of efficient international business. They're agreements between two countries.
To stop you getting taxed twice on the same income, right?
Exactly that. Avoids double taxation once where the money is earned and again where it's received.
And all three of these places have good networks.
Oh, absolutely. They've all invested heavily in this. The Netherlands has like over 100 treaties.
Wow, 100 plus. Singapore's got over 90, and Luxembourg has more than 80. These are really extensive networks.
And they help reduce those withholding taxes you mentioned on dividends.
Precisely. Dividends, interest payments, royalties, DTTs can slash or even eliminate the withholding taxes on these flows between the treaty partner countries.
Making cross-border stuff much cheaper.
Much more cost effective, yeah.
Yeah.
Really vital for any international structure.
Okay, great. So let's dive into each location specifically now. Starting with the Netherlands, the analysis suggests it's good for EU-focused structures, maybe companies with lots of IP or subsidiaries across the EU.
That's right. For businesses really centered on Europe, the Netherlands offers some very compelling advantages.
Like what?
Well, the big one is the participation exemption.
Okay, what's that?
Basically, if your Dutch holding company holds a qualifying stake in another company, say a subsidiary, then the dividends it receives from that subsidiary and any capital gains if it sells the shares are usually exempt from corporate tax in the Netherlands.
So it avoids taxing the same profit twice within the group.
Exactly. Prevents that internal double taxation. Plus, you've got the EU parent subsidiary directive working alongside it, which further smooths the flow of dividends within the EU, often cutting withholding tax to 0 between related EU companies.
Okay, powerful stuff for EU operations.
Very. Combine that with the huge treaty network we mentioned, a really solid, well-respected legal system, good infrastructure, access to EU talent, and capital. It's a strong package for Europe.
Makes sense. But nothing's perfect. What are the potential downsides or, things to watch out for with the Netherlands?
Good question. There are definitely things to consider. That 15% dividend withholding tax is still the starting point, even if treaties or exemptions can help.
Right, you still need to check if you qualify for reductions.
Exactly. And there's growing pressure globally and in the Netherlands on substance requirements.
Substance
Meaning the holding company needs to be real. It needs to show genuine economic activity or, maybe actual employees, an office, real decisions being made in the Netherlands. It can't just be a letterbox.
Okay. So no purely artificial setups just for tax reasons.
Precisely. The tax authorities want to see real economic links. Also, the base corporate tax rate, especially the higher tier, is higher than Singapore's flat rate.
True, they're 25.8% versus 17%.
And there's mandatory disclosure of the UBO, the ultimate beneficial owner.
So you have to declare who ultimately owns the company. Less privacy, perhaps.
Potentially, yes. Transparency is increasing everywhere. And finally, just the ongoing costs of compliance and administration in a sophisticated jurisdiction like the Netherlands can add up, maybe more than in some other places.
Okay, that's a very clear overview. So Netherlands?
Yeah.
Great for EU access, strong legal protections. That participation exemption is key, but watch out for potential dividend tax leakage, substance rules, and maybe higher running costs.
That's a good summary.
Right. Let's head south now, metaphorically, to Luxembourg. What's its niche? The analysis points towards holding and financing, investment structures, fund management.
Yeah, Luxembourg has carved out a really strong reputation in the financial world. It's traditionally been a hub for holding companies, financing vehicles, complex investment structures, and particularly for setting up and managing investment funds.
What makes it so good for that?
Well, like the Netherlands, it offers a full participation exemption on qualifying dividends and capital gains.
Yeah.
That's fundamental for holding structures.
Okay, same key benefit there.
Yes. Plus, it's known for its political and economic stability right in the heart of the EU. Its treaty network is also very solid, over 80 treaties.
Still pretty extensive.
Definitely. And Luxembourg also has a reputation for a high degree of confidentiality and strong investor protection laws, which appeals to certain types of investors and financial activities.
Interesting. Stability, financial focus, EU access. Sounds solid. What about the potential drawbacks or things to be mindful of if you choose Luxembourg?
Well, first off, that 12,000 minimum capital requirement we mentioned earlier.
Right. Much higher than the others.
It's a bigger hurdle up front, especially for smaller setups. Also, while exemptions exist for dividend withholding tax, that standard 15% rate applies unless you specifically qualify for an exemption. It's maybe not quite as automatically broad as some might hope compared to, say, treaty benefits.
So you need to check the specific exemption rules carefully.
You do. And compared to somewhere like Singapore, maybe the perception is that the setup process and day-to-day admin might be a bit slower, perhaps less digitally focused, although they are modernizing.
Okay.
And just like the Netherlands, Luxembourg faces scrutiny on, shell companies. You need to demonstrate real economic substance there to get the benefits and avoid being seen as purely tax motivated.
Right. That substance point seems common across the EU now.
It's a global trend, really. BEPS and related initiatives are pushing for it.
Okay, so Luxembourg. Great for finance, funds, stability in the EU, but higher initial capital. You need to be careful about dividend tax exemptions, and substance is key.
You've got it.
All right, let's pivot to our third location, Singapore. Our analysis suggests it's ideal for Asia-Pacific holdings, tech companies, investment structures. What's the big appeal there?
Singapore really shines, especially for businesses targeting Asia or those prioritizing tax simplicity on distributions.
We already heard about the 0% dividend tax and no capital gains tax.
Exactly. Those are huge draws. Zero dividend withholding tax means profits flow out without an immediate tax hit. No capital gains tax is massive for investors or companies planning future divestments.
And the low capital requirement, too.
Right. That S1 makes starting up incredibly easy from a capital perspective. On top of that, Singapore is known for a very efficient, straightforward incorporation process.
Business-friendly is the term you often hear.
Very much so. Business-friendly laws, a strong legal system based on English common law, a great and growing tax treaty network, especially within Asia, and it's a fantastic gateway to the ASEAN market.
ASEAN being the Association of Southeast Asian Nations.
Correct. A huge and growing economic bloc. So for tech companies looking to scale in Asia or investment platforms focused on the region, Singapore offers a compelling package.
It does sound compelling, especially on the tax front for outflows. Are there any buts, any potential downsides or complexities with Singapore?
Yes, there are nuances. While the outflow taxes are great, Singapore doesn't have a general participation exemption, quite like the Netherlands or Luxembourg for incoming dividends.
Ah, okay. So dividends received by the Singapore holding company from its subsidiaries, they might be taxed.
They might be, yes. They could be subject to that 17% corporate income tax unless they qualify for specific exemptions. Singapore has various schemes, like the foreign-sourced income exemption, FSIE, but you need to meet the conditions.
So it's not automatic like the participation exemption in NL or Lux?
Not as broad or automatic, no. You need to look at the specific circumstances and whether your incoming foreign dividends meet the exemption criteria. Also, it's worth noting that pure holding companies in Singapore might not qualify for some of the generous tax incentives that Singapore offers to attract operating businesses.
Why is that?
Those incentives are often tied to creating local jobs, R&D spending, significant economic contribution in Singapore, which a passive holding company might not do.
I see. So great headline rates, but you need to check the details on incoming income and incentive eligibility.
Exactly. The specifics of your income sources and activities matter.
Okay, that's a really important clarification. So Singapore, amazing for tax-free dividends out, no capital gains tax, easy setup, great Asia access, but need to be careful about tax on incoming dividends and maybe fewer incentives for pure holding activities.
That captures it well.
Right. So based on all this fantastic detail, if you had to give some sort of thumbnail guidance, when would a business lean towards the Netherlands versus Luxembourg versus Singapore?
Okay, boiling it down. If your main game is accessing and operating within the EU market, and you value that strong legal framework and deep treaty network, the Netherlands is often, the prime candidate.
Makes sense. EU focus equals Netherlands.
For businesses really focused on financial engineering, holding investment funds, maybe wanting that regulatory badge of quality within the EU financial system, Luxembourg is still a very strong contender.
Right. Finance funds equals Luxembourg.
And if your strategic focus is really on Asia Pacific, if tax efficiency on getting money out, dividends, capital gains is paramount, and you want a really smooth, straightforward setup, then Singapore looks incredibly attractive, especially for tech and investment plays into Asia.
Tax simplicity, Asia access, Singapore.
Pretty much. It really comes down to matching the jurisdiction's strength with your specific business strategy, your geographical focus, and your tolerance for different types of complexity or cost.
That's a super helpful summary. It really highlights that there's no single best place, is there? It's about the best fit for your specific needs.
Absolutely. There's no one-size-fits-all answer in international structuring.
Yeah, and, it's interesting. This source material we looked at mentioned positive ratings for a firm called On Demand International. They seem to specialize in exactly this kind of decision-making.
Yeah, seeing those high ratings, like 4.8 out of 5 on Google and Trustpilot, it kind of underscores how complex this can be.
Right. It suggests that getting good advice from people who navigate this stuff daily is probably pretty valuable.
Definitely. The intricacies are real, and weighing up all these factors, tax, legal, substance, cost, market access, it benefits from experienced guidance.
So the key takeaway for you listening in is that these three jurisdictions, Netherlands, Luxembourg, Singapore, each bring something different to the table for a holding company.
Whether your priority is cracking the EU market, finding the most tax-efficient structure overall, or positioning yourself for growth in Asia, understanding these core differences is really that crucial first step.
And as you think about your own business, your own potential international moves, it really prompts the question, doesn't it?
It does. What really matters most to you? Is it the immediate tax hit? Is it the long-term regulatory stability? Is it how easily you can access your key markets? Or is it the day-to-day administrative burden and cost?
Which of those factors really tips the scale for your specific plans?
Yeah.
And maybe building on that, thinking about these different options, what specific questions does this raise for you, for your business, for your investments? It's a complex but fascinating area to navigate.
Definitely food for thought.
Well, we hope this deep dive has shed some useful light on it all. Thanks for tuning in.